Every time inflation rises, more than 200 different tax limits, credits, and thresholds in Canada fail to move with it, creating what experts call a hidden tax. As the cost of goods increases, these unindexed items stay frozen, effectively pulling more money out of your pocket without a single new law being passed. To combat this invisible drain, start tracking your net effective tax rate rather than just your gross income. A report by Jamie Golombek at Step Canada highlights a systemic flaw where dozens of tax thresholds are not adjusted for inflation. This means that even if your nominal income stays the same, you can be pushed into higher tax brackets simply because the thresholds remain static while prices rose. To manage this, review your previous year's tax return to see if you have drifted into higher brackets due to inflation-driven income increases. When the Bank of Canada maintains a policy rate like the current 2.25%, it is attempting to stabilize prices, but it cannot fix the structural tax gap. When the government fails to index tax thresholds, they are essentially capturing more revenue through inflation rather than through policy changes. You should prioritize tax-advantaged accounts like the FHSA or RRSP to shield as much income as possible from these creeping tax drags. This hidden tax is most felt at the grocery checkout and the gas pump, where prices rise while your tax-free thresholds do not. As the USD to CAD exchange rate hits 1.3938, the cost of imported goods rises, further widening the gap between your actual income and your purchasing power. To defend your wallet, focus on reducing non-essential discretionary spending to create a buffer against these unindexed cost increases. The lack of indexing creates a progressive tax creep that hits middle-income Canadians the hardest as they rise through brackets without a corresponding increase in real wealth. This effectively acts as a silent revenue generator for the government that bypasses the usual political scrutiny. Advocate for policy changes by contacting your member of parliament to support automatic inflation indexing for all tax thresholds. Market indicators like the 10-year yield at 3.69% and the 2-year yield at 2.98% reflect broader economic expectations that inflation is still a primary concern. Even if interest rates stabilize, the failure to index tax limits means the tax burden will continue to grow in real terms. Keep a close eye on quarterly inflation reports to predict when your tax liability might feel the squeeze. The biggest takeaway is that inflation is not just about rising prices. It is also about the silent erosion of your tax-free thresholds and credits. You cannot control government policy, but you can control your tax efficiency and spending habits. Subscribe to stay ahead of these structural shifts in the Canadian economy.